Welcome to this deep dive
Oh, yeah.
into the world of investing.
Very exciting.
We're going to be exploring a really fascinating book
Okay.
called The Four Pillars of Investing by William Bernstein.
Yeah, a classic.
And we're going to be, kind of pulling out
Mhm.
some of the key insights from this book.
Right?
And it covers, a really wide range of topics.
Yeah.
Investment theory,
Uh-huh.
financial history,
Okay.
the psychology of investing,
Mhm.
the practical business of investing.
Yeah, it's really kind of a comprehensive look.
Yeah, so our mission here is to
Mhm.
really help you understand the core principles
Right.
of successful investing and to
Yeah.
help you avoid some of the common pitfalls.
Absolutely.
Um, and I think one of the most fascinating things that Bernstein starts off with is
Easily.
the story of Sylvia Bloom,
Yeah.
who was a legal secretary
Mm-hmm.
who quietly built a $9 million fortune
Wow.
through investing in common stocks.
That's incredible.
And what's really interesting about her story is
Yeah.
she wasn't chasing hot stock tips or
Mhm.
trying to time the market.
Right.
She was just making smart,
Mhm.
consistent investments over a really long period of time.
Yeah, that's the power of compound growth, right?
Exactly.
You just let it do its thing over decades.
Yeah, and it really highlights
Yeah.
this idea that you don't have to be a Wall Street wizard to be successful in investing.
Yeah, you don't have to be some genius to build wealth like that.
Exactly.
Yeah.
And that leads us to
Look at-
Bernstein's framework, which
Yeah.
is the four pillars of investing.
Right.
And these are the four things that he argues are essential for
Essentials.
building a solid foundation
Yeah.
for your financial future.
I like it.
So let's dive into pillar one,
Okay.
which is investment theory.
All right.
And one of the big things that
Yeah.
Bernstein emphasizes in this section is that
Okay.
risk and return are inseparable.
Yeah, you can't have one without the other.
Right.
If you want high returns, you got to be willing to take some risk.
Yeah, and one of the big myths that he debunks
Okay.
in this section is the idea of market timing.
Oh, market timing.
Yeah. He argues
Good
that
folks.
it's incredibly difficult
Yeah.
to predict market ups and downs
Mhm.
consistently.
Right. If you could do that,
Yeah,
you'd be a billionaire.
exactly. And even if you manage to get out at the right time,
Right.
knowing when to get back in
Yeah.
is just as tricky.
It's like trying to catch a falling knife.
Yeah.
It really is.
And he uses the 2008 financial crisis as a prime example.
Okay.
The S&P 500
Mhm.
dropped
Uh-huh.
dramatically.
Yeah.
But then it gained over 644%
wow.
from its lowest point by the end of 2022.
So if you got out
Yeah,
thinking you were going to avoid the crash,
right.
and then you missed
Yeah,
that whole bull market,
Mhm.
you would really regretted it.
big time.
Yeah.
Yeah.
So
Trying to time the market can
Yeah.
really backfire.
that's the message, right?
Yeah, instead,
Yeah.
Bernstein advocates for a long-term,
Mm-hmm.
disciplined approach to investing.
Buy and hold, baby.
Exactly.
Yeah.
So how do we estimate
Okay.
what kind of returns we can expect
Right.
over the long term?
Yeah, because we can't predict the future.
Exactly.
We can maybe get some clues.
Yeah.
Right.
So Bernstein introduces this really interesting concept
Mm-hmm.
called the Gordon equation.
The Gordon equation.
And
Yeah.
basically this equation provides a framework for
Okay.
estimating long-term stock market return
Right. Right.
using
Oh.
dividend yield
Yeah.
and expected dividend growth.
Interesting.
And what's fascinating about this is it can help you see
Okay.
whether a seemingly hot stock
Yeah, like one that's
Oh, yeah.
really popular right now.
exactly is
Mhm.
truly undervalued
Well-
or just riding a wave of hype.
Right. So it kind of gives you a way to like
Yeah.
cut through the noise.
It's like having X-ray vision
Yeah, like
into future returns.
Yeah.
But then Bernstein tackles another common misconception.
Okay.
Do stocks become less risky over time?
Less risky over time. That's interesting.
Yeah, and
But-
a lot of people believe that
Yeah.
holding stocks for longer periods reduces their risk because the market's ups and downs kind of average out.
Right. Right.
But Bernstein cautions against
Stop
this
it.
oversimplification.
Interesting.
He explains that while longer holding periods can smooth out returns,
Okay.
to some extent,
Mm-hmm.
the potential for what he calls deep risk,
Deep risk. Okay.
which is the possibility of significant losses,
Yeah.
always remains.
Always remains. Okay.
And he uses a really compelling comparison
Yeah.
of two hypothetical retirees.
Right.
Illustrate this.
I'm intrigued.
Mr. Forward
This is forward.
and Mr. Reverse.
Mr. Reverse, okay.
And they both invest in the U.S. stock market.
Okay.
Starting in 1967.
Well,
but they experienced the same returns.
the same returns.
In reverse order.
In reverse order, okay.
So Mr. Forward experiences a brutal bear market.
Oh, no.
Early in his retirement.
Uh-oh.
And his nest egg suffers. And he eventually runs out of money.
Wow. Okay.
Mr. Reverse, on the other hand,
Yeah.
benefits from a booming bull market.
Lucky guy.
Early on.
Yeah.
And his portfolio thrives.
So just the order of those returns.
It really highlights how the timing of returns can drastically impact retirement outcomes.
Even with the same overall returns, that's crazy.
Even with identical overall returns.
So sequence of returns risk.
Exactly.
Okay, got it.
So it's a powerful reminder that we can't control the market's timing, but we can control our reaction and plan accordingly. And a big part of that planning involves understanding real returns.
Real returns.
And Bernstein points out that investors often focus on nominal returns, which don't account for inflation.
Right. It's like looking at the sticker price of a car.
Exactly.
And not thinking about the taxes and fees.
Yeah. It's like thinking you got a great deal.
Right.
Only to realize later that
Yeah.
the price didn't include taxes and fees.
Right.
So we need to think about returns in terms of their purchasing power. And that means factoring in inflation.
Okay.
And he highlights how even seemingly safe investments like U.S. Treasury bills have struggled to keep pace with inflation.
Really?
Over the past century.
Wow, okay.
So, that segues perfectly into Pillar 2.
All right, Pillar 2.
Which is investment history.
Investment history.
And this is where Bernstein takes us on this fascinating journey through the evolution of financial markets.
Oh, wow.
From ancient debt and equity markets to the rise of modern stock exchanges.
I'm intrigued.
And it's remarkable how Bernstein connects ancient financial practices to the modern investing landscape.
Right.
And he argues that as societies become wealthier, investment returns tend to fall.
Investment returns tend to fall.
Yeah, and it seems kind of counterintuitive.
Yeah, why would that be?
But his point is that in early economies, capital was scarce.
Right.
And transaction costs were high.
Yeah, that makes sense.
So investors demanded higher returns to compensate for those risks.
Right.
But as societies develop, capital becomes more abundant.
Right.
Technology reduces transaction costs and competition increases. All of these factors push returns downward.
Okay.
So we shouldn't necessarily expect the same high returns that investors enjoyed decades ago.
That our parents or grandparents maybe got.
Exactly.
Yeah.
And this historical perspective is really essential for setting realistic expectations and avoiding the trap of chasing returns that are unsustainable in today's markets.
Okay. And this brings us to...
Speaking of unsustainable returns... Market bubbles.
Market bubbles.
Yeah.
Let's talk about those.
Bernstein examines classic examples. Like the Mississippi Company. The South Sea Bubble. English Railway Mania. And the 1920s stock market. To illustrate the recurring patterns of these periods of irrational exuberance.
Right. When everybody thinks this time it's different.
Exactly. And... he provides some really insightful advice on how to spot a bubble forming. He suggests paying attention to the level of speculation in everyday conversation.
So like when you hear your Uber driver talking about stocks.
Yeah. Okay. That's a definite red flag.
What else?
He also cautions against falling for extreme predictions and the allure of can't miss investment opportunities.
Right, because those often turn out to be mirages.
Exactly.
And speaking of mirages, let's move on to
Pillar 3.
Pillar 3.
Yeah. investment psychology.
This is a good one.
And this is where Bernstein dives into how our brains are wired to make us. Well, less than ideal investors.
Oh, I know all about that.
Yeah. And he introduces the concept of System 1.
System 1?
And System 2 thinking.
System 2 thinking, okay.
And System 1 is our fast, intuitive, emotional brain, while System 2 is our slower, more rational, deliberative brain.
All right.
And Bernstein argues that our System 1 often hijacks our financial decision-making, leading us to make emotional choices that can sabotage our long-term goals.
Oh, I've been there.
Yeah.
Yeah.
And he uses a fascinating coin flip betting experiment.
Coin flip betting experiment.
To illustrate this point. And basically, participants in this experiment consistently make irrational decisions.
Even when they know the odds are stacked against them.
Even when they know the odds are stacked against them.
So their emotions are just taking over.
Because their emotions take over.
Yeah. So it's like a casino.
Exactly.
Yeah.
It's like...
You know you're probably going to lose.
Yeah.
But you do it anyway.
You get caught up in the moment.
Yeah.
And Bernstein goes on to discuss the dangers of overconfidence.
Overconfidence, yeah.
We tend to overestimate our abilities and take on more risk than we can handle.
Especially when the market's doing well.
The market's doing well.
Right.
Hey.
It's like we think we're geniuses when the market's going up.
We think we're invincible, stock-picking geniuses.
Exactly.
Until the market throws us a curveball.
Until it doesn't.
Which it inevitably will.
Right.
And he urges us to be honest with ourselves about our risk tolerance and to reflect on how we've reacted to past market downturns.
Oh, interesting.
Because our perceived risk tolerance might be very different from how we actually behave.
Yeah. How we actually feel.
Yeah.
When we're losing money.
When we're faced with real losses.
Yeah.
And then there's envy.
Envy.
That nagging feeling of wanting what others have, especially when it comes to investment returns.
Yeah. Keeping up with the Joneses.
Exactly.
Yeah.
And Bernstein warns against comparing ourselves to others and chasing the latest hot investment.
Because that can...
Yeah. Because it can
lead us down the wrong path.
Lead us down a path of unnecessary risk.
Yeah.
And disappointment.
And disappointment, right? Yeah. He reminds us that building a solid, diversified portfolio is not about trying to keep up with the Joneses.
Yeah, exactly.
It's about achieving our own financial goals.
Exactly. And which brings us to
Pillar 4.
Pillar 4, okay.
The business of investing.
A business of investing.
And Bernstein doesn't mince words here.
Okay.
He describes the financial services industry as
a
battlefield.
A battlefield, wow.
Where investors need to be on their guard.
On their guard, okay.
And so he pulls back the curtain on an industry that often prioritizes its own profits over the best interests.
For the best interests.
Of its clients.
Of its clients, yeah.
And he tells the story of Merrill Lynch.
Merrill Lynch.
Yeah.
A firm that went through a major transformation in the early 1980s. All right. Their focus shifted away from a client-centric model to one that was fixated on maximizing commissions and trading volume.
Got it.
Even if it wasn't in the best interest.
Wasn't in the best interest.
Of the clients.
Of the clients, right.
And it serves as a cautionary tale.
A cautionary tale.
Reminding us that not all financial professionals have our best interests at heart.
Yeah, be careful out there.
And we need to be discerning when choosing who to trust.
Right.
With our money.
Yeah. Who are you going to trust?
And this is where... the rise of index funds comes in.
Index funds, yeah.
Everybody loves index funds these days.
Offering investors a low-cost, efficient way to participate in the market without the high fees and potential conflicts of interest associated with actively managed funds.
Right. And Bernstein is a
staunch advocate for index funds. And highlighting the work of Jack Bogle. And the Vanguard Group in making them accessible. to the average investor.
To the average investor, right.
And
he addresses
the criticisms.
The common criticisms of index funds.
Of index funds, right. Because some people say they're not good for whatever reason.
Yeah.
He addresses all that.
And explains why they often outperform actively managed funds.
Over the long term.
Over the long term, and why they can be a cornerstone of a successful investment strategy.
They're simple. They're cheap.
Exactly.
What's not to like?
He also cautions against chasing performance.
Chasing performance.
And falling prey to hot money flows.
Hot money flows.
Where investors pile into funds or sectors that have performed well recently.
That have done well,
and they end up buying high and selling low.
Often ending up buying high and selling low.
The worst thing you can do.
Yeah. So it's like trying to time the market, but with fees.
But with higher fees.
Yeah, exactly.
Bernstein emphasizes a disciplined, long-term approach to investing.
Right.
Focusing on low-cost index funds and diversification as the most effective way to build wealth.
Over time.
Yeah. So I think a key takeaway from this deep dive into the business of investing is that the financial services industry can be a treacherous landscape.
Yeah, there's a lot of sharks out there.
You always need to do your due diligence, ask questions, and don't be afraid to walk away from any situation that doesn't feel right.
Yeah, trust your gut.
Exactly.
Okay.
So
now, how do we put all this together and start thinking about portfolio design and management?
Portfolio design and management, yeah. So Bernstein stresses that.
Asset allocation.
Which is
the mix of stocks, bonds.
Regular assets.
And other assets. And your portfolio.
In your portfolio is
the most important decision you'll make as an investor.
It's the foundation of your financial house.
It's the foundation of your financial house.
You want to make sure
it's
built on solid ground, sturdy enough to withstand any storm.
Absolutely.
But remember, there's no one-size-fits-all approach to asset allocation.
Asset allocation.
The right mix for you will depend on your
individual circumstances,
your risk tolerance, your time horizon,
your
goals, right?
And
Bernstein offers
some helpful guidance on how to figure out your asset allocation based on factors like
your age,
your income, and your investment goals. He also delves into the pros and cons of different asset classes.
All right.
Like
gas,
U.S. stocks, international stocks, bonds,
and real estate.
So he kind of gives you a landscape.
Helping investors understand the risks and potential rewards of each. And this is where
diversification comes in.
Diversification.
As a crucial principle of portfolio design.
Right? Don't put all your eggs in one basket.
By spreading your investments across different asset classes, you reduce the impact of any single investment performing poorly.
So if one thing blows up, the rest of your portfolio is okay.
Exactly.
Okay. And Bernstein also introduces
the
concept of tilting.
Tilting your portfolio.
Tilting your portfolio towards certain factors. Like value and small cap stocks. Which have historically outperformed the broader market.
Over the long run. But he's careful to point out that factor investing is not a guaranteed path to riches.
Yeah. There's no guarantees in the stock market.
These factors can experience periods of underperformance.
Right. They can get down to rust patches.
Exactly.
Right.
And it's important to be patient and disciplined. If you choose to pursue this strategy. So don't expect to get rich quick with any investment strategy, no matter how enticing it sounds.
There's no shortcuts to building wealth.
Exactly.
It takes time.
Patience
and discipline.
Yeah.
He also recommends.
Patience recommends.
High quality.
Short-term bonds.
Short-term bonds.
Especially for investors.
Yeah. Who are closer to retirement.
Closer to retirement, yeah. Those can provide stability and liquidity.
Okay.
Acting as a cushion.
Yeah.
When the stock market
gets bumpy.
That
makes sense.
Yeah.
And then he walks us through some model portfolios. Ranging from simple two-fund portfolios to more complex
multi-asset class portfolios.
Multi-asset class portfolios, okay.
Illustrating the trade-offs. Between simplicity and the potential for higher returns.
So he's really giving us options here.
He's giving us options.
Yeah.
He wants to empower investors. To make informed decisions. About how they structure their portfolios. There's no one right way to do it.
Yeah. It depends.
It depends on your individual
circumstances.
Preferences, yeah.
And it's refreshing to hear that level of honesty and transparency. Especially in a field that can often feel opaque and intimidating.
Yeah. Very jargony.
Exactly. Yeah.
And then there's
the question of
rebalancing. How do you keep your portfolio aligned with your target asset allocation as your investments perform differently over time as things change?
Right.
Yeah.
It seems like an easy thing to
overlook. Yeah, especially if you're not.
Especially if you're taking a long-term approach.
Right.
And not checking your portfolio every day.
Every day, yeah. Bernstein points out that
rebalancing is
essential.
Essential for maintaining your risk profile. Maintaining your risk profile
and ensuring
that you're not overexposed
to any single asset class,
to any one thing. He offers guidance on how to approach it.
Okay.
Taking into account factors like
time commitment.
I mean,
a tax situation. And whether you're using tax-advantaged accounts. It sounds like rebalancing can be as simple or as complex. As simple or as complex.
As you want it to be.
Yeah.
You can set up.
Yeah, you can automate it.
Automatic rebalancing.
Through your brokerage account.
Or you can take a more hands-on approach.
You do it manually.
Yeah.
A couple times a year.
And rebalance manually a couple times a year.
Whatever works for you.
Okay.
Yeah. And Bernstein also offers specific advice.
For
investors.
Investors approaching. Or in retirement,
huh? Suggesting a reduction in equity exposure. As you get closer to needing to draw down your savings. So it's all about aligning your investment strategy. With your life stage. And financial goals. So now that we've covered having 4 pillars. And talked about putting those principles into practice.
What final
pieces of
advice
does Bernstein
leave us with? Well, he stresses the importance of staying disciplined. Avoiding emotional decisions.
It's so easy to get swept up.
It's so easy to get caught up in the
market hype.
And make impulsive choices.
That you later regret. Or conversely, to panic.
And sell everything.
When the market takes a downturn.
Yeah.
Our emotions can be
our own worst enemy. When it comes to investing. Exactly.
So to combat that. He advocates for
a
long-term perspective. Remember, investing is a marathon.
Not a sprint.
There will be ups and downs along the way. But the key is to stick to your plan. And not let short-term fluctuations derail you from your long-term goals. So it's about tuning out the noise. And focusing on what you can control.
Yeah.
Which is your own behavior. And your commitment to your
investment strategy.
He
also reminds us that.
We're
not alone in this journey.
There are countless resources
Countless resources.
Available to help us.
Available to help us.
Make informed decisions.
Make informed decisions. Books. Articles.
Graphical
websites. Financial advisors.
Financial advisors.
And even podcasts like this one.
Like this one.
Don't be afraid to.
Don't be afraid to.
Seek out information.
Seek out information.
And ask questions.
The
more you understand.
About
how markets work.
The
more confident you'll feel. About making decisions.
That
are right for you.
As
we've learned from Bernstein's The 4 Pillars of Investing. Knowledge is power. When it comes to building. A secure financial future. So what
concrete steps can listeners take? Right now. To apply this knowledge. Well, if you haven't already.
Okay.
Take some time to create that budget. We discussed earlier. Even if it's just a basic overview. Of your income. And expenses.
It can be
incredibly illuminating.
It could be a great first step toward taking control of your finances.
Taking control.
Oh, yeah.
Setting yourself up for success.
Yeah.
Absolutely.
And if you're ready
to
start investing,
consider opening an investment account. You don't need
a huge sum of money. To get started.
Even a small amount. Invested consistently over time.
It
can grow significantly. Thanks to
the power of compound growth. I think a lot of people are intimidated by the idea of investing.
But
it doesn't have to be. Complicated. There are plenty of resources available to help you. Get started.
And there are
many simple
low-cost ways to invest. That's a great point.
And if you're feeling overwhelmed, remember that.
Simplicity is often
the best approach.
Start with the basics. Build a diversified portfolio. Of low-cost index funds. And then you can expand from there.
Okay.
As you
gain more experience and knowledge.
And don't be afraid to. Seek out guidance. From a financial advisor. If you need help.
Absolutely.
Finding a fiduciary.
Who
understands your goals. And is committed to acting. In your best interests. Can be invaluable.
Now, before we wrap up this part of our deep dive into the 4 pillars of investing.
There's one more topic.
Okay.
I'd like to explore.
I'm listening.
The ongoing debate about the suitability standard. Versus
the fiduciary standard.
In
the financial services industry.
Yeah. And this is an area where Bernstein has some strong opinions.
He doesn't.
Especially about the potential conflicts of interest.
He calls the financial services industry a battlefield.
Yeah.
Where investors need to be.
He doesn't mince words.
Vigilant.
He describes the financial services industry as a battlefield. Where investors need to be on their guard.
Yeah.
So
for those of us
who
aren't
financial experts.
Can you break down
the
difference between the suitability standard
and the
fiduciary standard?
Simply put, the suitability standard.
The suitability standard
only requires
a
financial professional to recommend investments
that are suitable for your age, income, and investment objectives. That doesn't necessarily mean they have to
act
in your best interest.
That seems like a
pretty low bar. So
could they recommend an investment?
Yeah, could they recommend something that earns them
a higher commission?
A big commission.
Yeah.
Even if it's
not the best option.
Not the best option for you.
For me.
Yeah, that's the loophole.
Yeah.
And Bernstein highlights how this can lead to practices
that
don't serve the client's best interest.
Don't serve the client's best interest, like recommending high-fee funds.
High-fee funds!
When lower-cost alternatives are available. Lower-cost alternatives are available.
Yeah.
That's concerning.
That's concerning.
Yeah.
So what about the fiduciary standard?
What about fiduciary? The fiduciary standard.
The fiduciary standard
requires a financial professional.
A financial professional.
To put their clients' interests.
To put their clients' interests.
Above their own. Above their own.
They have a legal and ethical obligation.
Legal and ethical obligation.
To act in your best interest.
In your best interest.
Even if it means sacrificing some potential profits.
That sounds much more aligned with what I would want for
you would want
managing my money.
Exactly. And Bernstein's a big proponent of that.
And Bernstein is a strong advocate for the fiduciary standard.
He believes it's the only way to ensure that
investors are receiving truly
unbiased advice.
It's
surprising that it's not the industry standard.
Not a standard.
Across the board.
And Bernstein argues that the continued prevalence of suitability allows for those questionable practices. We were talking about excessive trading. High fees. Pushing complex products.
That benefit the seller. More than the buyer.
So how do we find these trustworthy advisors?
These good advisors who
operate under the fiduciary standard.
What should we look for?
What red flags should we watch out for?
Red flags. Well, a big one is if a financial professional.
A financial professional.
Seems overly focused on selling products.
Rather than
the time to understand
your individual needs and goals. If they're
pushing specific investments,
really understanding your overall financial picture.
Their big picture.
That's a sign to proceed with caution.
What about fees?
Fees and commission.
Should we always be
looking for
the lowest
possible fees?
It's not always that simple.
Okay.
Sometimes higher fees might be justified. If you're receiving
specialized services.
Or
expertise.
But
you should always understand.
How
your advisor
is compensated. And whether there are any potential conflicts of interest. We won't be afraid to.
Don't be afraid to.
Ask tough questions.
It's your money after all.
It's your money.
Now, before we wrap up. Was deep dive.
This deep dive.
I wanted to touch on something else that Bernstein talks about.
Something else? What's that? He talks about
the dangers
of
investment pornography.
What is that? What's he talking about?
And he's referring to the constant barrage of financial news and get-rich-quick schemes. That can be incredibly distracting.
Even harmful.
And harmful for investors.
It's like they're trying to convince us.
That
investing is this high-stakes casino game rather than a long-term strategy. And all that noise can lead investors. To
make impulsive decisions.
Chase performance.
And trade too frequently.
Which
erode their returns.
Seriously erode their returns over time.
Yeah,
it can feel
overwhelming. Trying to sift through
all the information
and figure out what's
real
and what's just
hype.
And Bernstein advocates for a more mindful approach. He recommends limiting your exposure to financial news. And avoiding the temptation to constantly check your portfolio. It's easier said than done. In today's hyper-connected world.
But I see the wisdom in that.
The more we obsess over
short-term
fluctuation,
the more likely
they're
to make emotional
decisions.
So he suggests.
Focusing
on the thing.
Focusing on.
You can control. Like your.
Asset
allocation.
Your savings rate. Yeah.
Your investment costs.
Your costs.
And
sticking
to your long-term plan.
Long-term plan.
So what's the antidote? To this investment pornography?
So all this noise.
Yeah.
Education.
The
more you understand. About how markets work.
The
less likely you are to be.
Swayed by the latest fad. Or fear-mongering headlines. That's a great point.
Yeah.
And it brings us back.
To
the core message. The 4 pillars of investing.
Of the book.
By understanding.
The principles.
Investment theory. History.
Psychology. And the business of investing. We can empower ourselves. To make informed decisions.
And build
a more secure financial future.
Exactly.
It's not about
finding the next hot stock tip. Or timing the market perfectly.
It's about
creating a sound investment
strategy based on
your individual
goals,
risk tolerance,
and time horizon. It's about being a student of the market,
understanding
the
forces at play, and making informed choices
that align with
your long-term vision. And remember, the journey might have. It's bumps along the way. But as Bernstein emphasizes,
patience,
discipline,
and a commitment to lifelong learning are the keys to success. In the world of investing. This has been fantastic.
Kind of deep dive.
A fantastic deep dive.
Thanks for
having me.
Walking us through the 4 pillars of investing. I know our listeners will find these insights valuable as they navigate their own financial journeys.
It's been my pleasure.
And I hope our conversation today encourages listeners to take that next step.
To take action.
Whether it's creating a budget, opening an investment account, or simply
committing to
learning more.
This fascinating world.
Yeah, it's a fascinating world.
Remember,
knowledge is power.
And
the power to create. A brighter financial future. Is in your hands.
It's all in your hands.
Thanks for joining us.
Thanks for having me.
On the deep dive.
It's been great.
Until next time.
Stay curious.
And keep learning.